Every trader will have his own personal preferences for support and resistance tools. Some traders will only use static levels, whereas others might use a mixture of classic and dynamic support and resistance. Unlike classic support and resistance areas, dynamic levels are support and resistance zones that change. Each time a new candle prints on the chart, the support and resistance level is readjusted, and the trader will use the new level for their decisions, and not the previous one. In today's video, we'll discuss the most important 10 trading indicators that will offer you dynamic zones of support and resistance. First indicator is the moving average. One of the benefits of using moving averages for finding dynamic support and resistance is their ability to be handy when the market price is going through a hidden area in your charts, away from major levels on the market. And as a Forex or a stock trader, you cannot ignore the moment when the price reaches the area of a moving average. You must understand that something is going to happen when the price reaches a moving average. It will bounce, or it will break through. The logic behind why moving averages as support and resistance work are very similar to why price moves. Let's say that most traders use 20, 50, 100 or 200 period moving averages. When more traders expect something to happen around these moving averages and they have a common goal, a move will probably happen. For example, you use the 1 hour chart and the price rises to the 50 EMA. That could be a really good dynamic support or resistance level. You'll notice that every time the price touches the 50 EMA, you'll see a bounce back down because the price uses this moving average as resistance. Of course, the price will not always perfectly bounce back from the moving average. Sometimes it will go a bit above before it starts going back in the trend direction. That's why one of the best ways to estimate the ability of moving averages as support or resistance is to watch price action around them and combine them with classic support and resistance levels. And this is valid for all indicators we'll discuss in this video. Number 2. Hourly pivot points. Pivot points plot 7 support and resistance levels intended to find intraday turning points in the market. Since many market participants track these levels, price tends to react to them. Pivot points have the advantage of being a leading indicator. They can either act as trade entry triggers themselves by using them as dynamic support or resistance, or as levels for stop losses or take profit levels. While many traders use the daily or weekly pivot points, you can also use the hourly pivots to find dynamic areas of support and resistance. The hourly pivots are calculated based on the high, low and closing prices of the previous hour, and they're excellent tools to predict dynamic support and resistance levels in the current or in the upcoming hour. Hourly pivots are a great way to identify intraday areas of support and resistance, and they work even better when combined with other kinds of technical analysis, like price action or other indicators. Third indicator is the Bollinger Bands. Graphically, Bollinger Bands are two lines that limit price dynamics from above and below. These lines act as a kind of support and resistance areas, which are located at levels far away from the current price most of the time. Bollinger Bands are drawn at distances equal to a certain number of standard deviations. Since the magnitude of the standard deviation depends on the volatility, the bands adjust their width. They increase when the market is volatile and decrease in more stable periods. Bollinger Bands identify natural extremes in an emerging trend. A dynamic resistance zone forms below the upper band, and a dynamic support forms above the lower Bollinger Band. The uniqueness of Bollinger Bands as dynamic support and resistance is that their width changes in response to changes in market volatility. The Bollinger Bands are plotted around the average, but the bandwidth is proportional to the standard deviation from the moving average for the analyzed period. When there is a lot of volatility in the market, for example during a news release, the band widens, and when the market is calm, it narrows. Number 4. Keltner Channel. Keltner Channel uses the average true range to determine the channel distance. The channels are typically set to average true range values above and below a 20-period exponential moving average. The upper and lower bands of the Keltner Channel can act as dynamic resistance and support areas. In a sideways market, when there isn't a clear trend on the chart, Keltner Channel will definitely provide excellent support and resistance. During trending markets, the Keltner Channel also serves as a reliable support and resistance area. you will often find that the price will retrace to the lower Keltner band during strong upward trends and to the upper Keltner band during downtrends. Number 5. VWAP. Sometimes, finding the average price based on the closing value will not provide an accurate picture of dynamic support or resistance, and this is where the VWAP comes into play. The VWAP identifies the true average price of a stock by factoring the volume of transactions at a specific price point and is not based on the closing price. This is where the VWAP can add more value than the standard 50 or 200 moving average indicators, because the VWAP reacts to price movements based on the volume during a given period. Some traders will use VWAP along with standard deviation bands, similar to how Bollinger Bands might be used. In a mean reverting environment, when the price is extended from fair value, we often see a reversion to the mean. A trader might short rejections at the upper standard deviation band of the VWAP, or go long on bounces of the lower standard deviation band of the VWAP. Number 6. Ichimoku indicator. One of the primary goals of the Ichimoku is to give you an idea where future support and resistance levels will be. To use it as dynamic areas, you will need to look at the conversion line, baseline, and Kumo cloud. In this uptrend, notice how the conversion line did a good job acting as support on minor pullbacks. The conversion line does this well because it's meant to track the underlying momentum in price action. If momentum is weak, you'll see this in the conversion line, with price crossing it more frequently and not respecting it. In this example, you'll also notice the baseline, which is supposed to track the underlying trend in the price action. Notice how as price pulled back deeper in the uptrend, it stopped at the baseline several times, offering potential trade setups to get in with this trend. Also, the top and bottom of the Kumo cloud are strong support and resistance levels. If price moves above the Kumo cloud, the top of the cloud acts as a first level of support and the bottom as the second level of support. Number 7. The Alligator. What makes the Alligator unique is the ability to shift its moving averages into the future, which adds another dimension to the dynamic support and resistance concept. The components of the indicator are a 5-period moving average that is shifted 3 periods into the future, an 8-period moving average that is shifted into the future by 5 periods, and a 13-period simple moving average that is shifted into the future by 8 periods. The moving averages converge when the market is in a range or consolidation. As the moving averages start to diverge, a new trend is forming, and the lines will become areas of dynamic support or resistance. When a trend is fully developed, the lines of the alligator are separated from each other and moving in the same direction of the trend. The bigger the distance between the lines, the stronger the support and resistance area. The bigger the time frame, the more difficult for the price to break through. Number 8. Smoothed Heiken-Ashi. Smoothed Heiken-Ashi is a modified version of the regular Heiken-Ashi candlestick chart. Price is in an uptrend when the smoothed Heiken-Ashi indicator is bullish or green, and it's in a downtrend when the smoothed Heiken-Ashi is bearish or red. When prices are trending higher, the smoothed Heiken-Ashi will adjust itself by also moving higher to reflect the increasing prices. This could be explained as a bullish signal. When you see the smoothed Heiken-Ashi trending higher, you could enter the market on the retest of the smoothed Heiken-Ashi, acting here as dynamic support. The opposite is true if the price is trading below the smoothed Heiken-Ashi, where you would then search for selling opportunities, as the market is signaling a downtrend. When price is below the Heiken-Ashi line, it acts as a dynamic resistance. Number 9. Chandelier Exit. The Chandelier Exit will be above prices during a downtrend and below prices during an uptrend, which makes it a good candidate to offer dynamic support and resistance. The Chandelier Exit sets a trailing stop loss based on the average true range, representing a volatility-based system. By setting the Chandelier Exit 3 ATR values below the period high, the indicator provides a buffer that is 3 times the volatility. A decline strong enough to this level offered the opportunity of long positions. So even though it is mostly used for stop losses, the Chandelier Exit can also be used as a trend tool, highlighting areas of dynamic support or resistance. A downward pullback to the Chandelier Exit signals a potential long entry if it aligns with a classic support and resistance level. while an upward pullback to the Chandelier Exit signals a potential short position. Number 10. Envelopes. Envelopes indicator is another tool that draws a dynamic price channel on the chart, helping to find trade signals. It consists of two lines, which are deviations up and down from a normal moving average, taken as the basis. If the deviation size is chosen well, the price chart remains in this dynamic price channel most of the time. Trading envelope bounces is preferred when there is no clear trend on the chart and the price is moving slowly. In this case, you may trade bounces of both borders of the envelopes indicator. If there is evidence that a trend is beginning, it would be wiser only to use the trades in the direction of the trend, bounces of the lower envelope in the case of an uptrend, and bounces of the upper envelope in the case of a downtrend. If you learned something new and found value, leave us a like to show support, subscribe to our channel and hit the bell icon to stay in touch with new uploads. Until next time.